Today, Byres' perspective on housing. Hello again, it's Martin North from Digital Finance Analytics Web. This post covering funds and property news with a distinctively Australian flavour. Well, Wayne Byres has given his final speech as chair of APRA. And during the speech, he made a number of interesting comments about housing. So I thought I'd relay those to you today because there are some quite thoughtful comments. He said, "Another constant feature of my time has been that Australian obsession, housing." He said, perhaps the most frequent statement I've made in my time as chair has been that APRA does not have a mandate to control housing prices, so I may as well make it one more time. APRA's interest in housing stems from our job to protect bank depositors who provide the funds that banks lend for housing, and from seeking to promote overall financial stability. We do that through ensuring bank balance sheets are sound and lending standards are appropriate. Incidentally, that benefits borrowers by limiting their capacity to overextend themselves and impacts housing prices through influencing the demand curve for housing. But both of those are indirect consequences of our core task. They are not our goals. And he went on to say, as ever low interest rates drove the housing cycle upwards, APRA sought to ensure competitive exuberance did not undermine basic credit standards. Much attention has been given to the benchmarks we temporarily introduced some years ago to temper investment lending and interest-only lending. But behind the scenes, against a backdrop of increasing risk, we have been persistently reinforcing lending standards across the board, improving income verification practices, insisting on more than assumption of poverty line living costs, requiring better assessments of a borrower's ability to service not just their mortgage, but their aggregate debt levels, and generally increasing the buffer for uncertainty. Australia now finds itself in the environment we all knew would eventually come, one of rising interest rates and falling house prices. Both are occurring sooner and at a faster rate than most people anticipated a year ago. When things shift suddenly and unexpectedly as they have, not everyone finds it easy to manage. Borrowers with only a small equity buffer and/or high levels of leverage relative to their income will be particularly challenged. Borrowers currently on very low fixed rates face a significant repayment shock in the future. The existence of some borrowers in difficulty, though, is not a sign of weak lending standards. After all, a bank that does not make a bad loan will be a bank that denies credit to many good customers. Banks will need to work with hardship cases sensibly, but prudent regulation is designed to ensure that downturns can be weathered. In Australia, the banking system is in good shape to weather the adjustment, and notwithstanding there will be pockets of stress within loan books, there is no sense it will threaten the soundness or stability of the system. The build-up of prudential strength has seen us navigate the past couple of years well, and with careful stewardship, we'll see the system resilient through the next few as well. And he went on to say, I would also like to add that it is not all downside from falling housing prices. Australian housing prices are undeniably high, and a sustained lower level of prices would not be a bad thing overall. Our decisions as a society to turn an ostensibly abundant resource land into something highly valuable requires the community to take on very high levels of debt to house themselves. First home buyers need more than a decade of diligent saving to put together a deposit, creating a major barrier to entry into the housing market. As a nation, we fret about housing affordability. The only way to genuinely improve affordability over time is to keep the rate of increase in housing prices below that of our incomes. From a narrow financial stability perspective, lower housing prices facilitating lower debt levels would not be a bad thing. From a broader societal perspective, I suspect there would be many more benefits from people having to use less of their income to simply put a roof over their head. Well, that's very well said, Mr. Byres, because it is true that the massive amount of debt required to take a property and live in a property at the moment is horribly high and puts huge pressure on society. Of course, the question is, will the banks be prepared to wear lower levels of profitability through the process? That, for me, is the critical question, and that's one which, from a financial stability perspective, is worth thinking about. But, point well made, lower house prices do actually have a benefit to society. That's something that real estate agents need to understand, perhaps, but then, of course, they're a rather different breed. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.